Hi, I'm Kristen King, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. One of the biggest questions in the minds of investors is just how quickly the U.S. economy will return to growth, or at least match its pre COVID levels of output. A problem we have is that the economic data which we normally rely on to measure the health and performance of nation states is not proving to be very useful. Simply put, that's because it's made up of either lagging indicators like GDP or forward looking indicators such as PMIs, which are survey based and therefore more reflective of opinions than facts. In the face of these issues, traders have turned to so called high frequency indicators and alternative data sets that say something about current levels of economic activity. This isn't an alien concept and has been a staple of trying to pin official Chinese economic data to reality for decades. Metrics such as changing levels of mobility and the number of trips made, restaurant bookings, online spending patterns, and footfall in key public spaces have all come into focus. In a sense, it's the digitization of the old equity analyst trick of counting cars in the Walmart parking lot ahead of earnings. Additionally, datasets modeled by regional Federal Reserves, like the New York Fed's Weekly Economic Index and the Atlanta Fed's GDP Now model, are being used more too. The attraction of these datasets is that many of them are captured online in real time and at scale. For example, mobility is captured by Google through people's cell phones, and the data is captured at regional, national, and international levels. Many of these datasets are trying to determine whether economies are seeing a pickup in aggregate demand and what effect rising or falling numbers of coronavirus cases have on consumer and business activities. However, a weakness of this approach is a lack of centralized methodology for analyzing and displaying data. It might actually be easier to look at segments of the markets whose prices are directly correlated to changes in economic demand. We can do just that by looking at commodities, which in many cases are the raw materials for vital components of the economy. Markets are forward looking, of course, and so one way that we can try to determine if commodities are priced for growth is to look at commodity futures prices. For example, if we look at the future curve for WTI crude oil, we see that contracts for November 2020 are trading around 37 per barrel. November 2021 prices are trading around $40 a barrel, which is around 10% higher. This suggests that oil markets are pricing in at least modest economic growth, assuming that there are no supply side issues impacting crude markets. If we look along curves for other consumables like copper, we find the picture less clear cut. In December 2020, high grade copper is trading around $3, but actually trading below that price at $2.89 for March 2022 deliveries. Copper is nicknamed Dr. Copper for its ability to indicate the overall health of the economy, and while prices are up 4.95% year to date, lower forward prices suggest demand is not expected to materially increase over the next 17 months. This paints a pretty dull picture as far as hopes of economic growth are concerned. If we looked into Trackstar, our proprietary search tracking software, we can screen the database to show us which commodities Wall Street professionals have been researching in recent weeks. What we find is that precious metals feature prominently. Gold and gold futures were the most viewed, while silver the second. Precious metals are seen as safe havens and alternative investments that do well in times of economic or political uncertainty. With a whole range of fundamental risk factors lined up ranging from COVID to the November election, it could be time to prepare for a bumpy road ahead. That's all we have time for. As always, make sure you do your own due diligence before making any investment decisions.